China's move that its currency, the Yuan, slide by some 3 to 4% against the US dollar has potentially huge ramifications for your portfolios, even if the currency shift itself, in monetary terms, isn't a big one. The real issue is that the Yuan's gently risen in value for more than a decade, only for this process to now come to a grinding halt, as the chart behind us shows. The People's Bank of China, or PBOC, said this is a one-off, but I'm a great believer in the old phrase, never believe anything till it's been officially denied, so further moves look perfectly possible. Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this week's Breaking the Mould, I'm going to look at what China's monetary manoeuvrings could mean for your portfolios. The first issue to consider is, why has China acted now? There are three schools of thought. First, supporters argue China's decision to slowly let the yuan float is part of Beijing's master plan to open up its financial markets to foreigners, attracting overseas capital and giving its economy a long-term boost. Second, doubters counter that the currency switch is a panicky policy designed to boost growth at a time when exports are sliding and overall GDP growth is struggling to meet the 7% target laid down by the Communist Party. Third, the downright sceptical simply say the Communist Party has made an awful mess of the whole thing, allowing a stock market bubble to form and then burst, and then altering its currency policy in a manner that's not decisive enough to help on either of the two counts above. Now, first and second points, master plan or panic, suggest equally that there could be more to come, despite the PBOC statements to the contrary. And if the yuan is devalued in a more dramatic way, mid-August's financial market action could be a useful pointer as to what may happen and what investors must therefore consider when it comes to building a portfolio. 1. Government bonds rallied, especially at the long end, as investors sought protection from a possible deflationary shock caused by China using a cheaper currency to export its way out of trouble. 2. Stock markets generally stumbled, particularly across emerging markets, and sectors such as commodities and energy were hit particularly hard amid fears of a real slowdown in China and again concerns over exported deflation. 3. Raw material prices slid, notably oil and copper. 4. Emerging market currencies took an absolute pasting. Counters ranging from the Malaysian ringgit to the Russian ruble to the Mexican peso all fell sharply, as investors with very long memories remembered how 1994's China devaluation preceded a massive Asian currency and debt crisis by just 3 years. Now, it's unlikely Beijing's going to move quickly. Many high-profile members of Congress in America have long railed against China as a currency manipulator, and nobody will want to get involved in a slanging match that could ultimately lead to damaging trade sanctions. But if China does devalue further and seek to export its way out of trouble, sending deflation around the world in the process, then some research from French investment bank BNP Exane Paribas could provide some pointers on which sectors could be most affected. Do note, however, this is research for institutional investors and is in no way intended to represent advice for retail portfolio builders. Now, BNP's work argues investors may need to think about three things. 1. The percentage of sales recorded in China. 2. Competition from cheaper Chinese goods and services. And 3. Any cost benefits from cheaper raw materials. Now, all of this points to a focus on domestic UK-focused players that have little sales exposure to China. Banks, real estate, travel and leisure and telecoms are possible examples. Cost-based winners who could include retailers source a lot from China. Next and Marks and Spencer's maybe. This chart here shows actually which sectors have the greatest sales exposure to emerging markets overall, but note it does it on a pan-European basis, including both the continent and the UK. The next and final graphic shows which areas have got the least sales exposure, again on a pan-Europe basis, including the UK and the continent. Sectors which therefore may not welcome a Chinese devaluation from a demand perspective could include luxury goods, high-end drinks, autos and mining. Areas which may feel the heat from increased price competition would include technology, chemicals and industrial areas like paper, steel, pulp and cement. All of this does though assume further downward movement in the Chinese currency, which as they said isn't guaranteed. So let's see what happens. Thank you for watching and I look forward to seeing you next time.